So think about this. It's being sold as this income advantage, and just the word play on income advantage IUL makes you think this thing is designed to help you build income later in life. But right here it says, no, this is designed to replace your income with life insurance should something tragic happen to you. That is the purpose of this. So this is another reason I don't like the nuanced, manipulative kind of plays in the wording with these contracts, because even the companies are kind of playing part in this. And like Mutual of Omaha says, well, we know that the income advantage IUL, that's going to be a sexy term. And they're kind of setting their agents up to go out and fail to an extent, because they're going to market them as like, these things are income advantage products, right? Like, but it's not. It says right here, it's designed to replace income should you pass away. Hey, what's going on, cash flow hackers? It's Chris, and today we are going to be going over the MPI illustrations. Now, full transparency, this is an illustration that I had somebody make for me. I did get an illustration directly from Curtis Ray, and as a man of my word, I am not going to use that illustration because I promised him I would not use it publicly. So I am not going to use it publicly. That said, I will say that I had this illustration made. It is the same company. It has access to the same features. It is the same exact policy. It's a Mutual of Omaha income advantaged IUL. And the reason for this is to go through, what I'm going to do today is I want to go through line by line, effectively page by page of the illustration, and educate people as to what is going on in the moving parts in the background of these MPI policies. One of the greatest heroes, quote unquote, of MPI is the RELOC feature inside of the policy. Now, that RELOC feature that's being touted as kind of like the hero of the MPI element is actually one of the greater danger components of what MPI really is. And here's what I'll say. If you watch my content, you know I'm not a big believer in IULs. You know that I think they're one of the most missold products on the face of the earth. However, what I will also say is that as a whole, if you're going to utilize IUL, Mutual of Omaha is actually not a bad product to use. They are one of the better IUL products with the lower cost of insurance, and it is what it is. So I'm not really saying that this product is bad. I'm just saying you need to understand what you're utilizing it for and leveraging it in the way that they're selling it as an with MPI is just misleading. And so I think by the time I get through this illustration and we go through and we read the actual fine print in this contract, because remember, life insurance is simply a contract. And when you take part in that contract, there are components, elements of the contract that are guaranteed to you. And they are benefits and rights of you, the policyholder. And then there are benefits and rights for the insurance carrier. And so you need to make sure you are on the right side of that equation to be able to set yourself up for success. And I'm a big believer, the number one element that we're always looking for in anything that we do with our money is control. And when you participate in Index Universal Life, you're giving up a lot of that control to the carriers. You're giving your rights away to the carriers. And that's one of the biggest reasons that I don't like these things. So let's get into this. I have an illustration. I've gone through it. I've marked it up. I've kind of utilized a PDF editor just to kind of highlight some areas and stay focused on some components. Otherwise, this would take forever. But I'll tell you what, I'm going to go through page by page. I'm going to focus on the key components of the policy that I think are going to be extremely valuable for you to understand, so you can make an educated decision on what you want to do moving forward with your money. So here we go. All right, so here we go. Let's get into, I had the agent title this MPI illustration example with RELOC because we're showing policy loans. Now I'm going to get into more detail on what's going on later with all that. You can see here, like MPI does, I did increasing death benefit during the funding years, and then I leveled the death benefit off after that because that's just kind of what they do. We're utilizing indexed loans here, doing an initial premium outlay of $18,000 a year. And so I've got, like I said, I've got notations on here that I want to spend a little time talking about some of these areas and components of the policy and the fine print of the policy that I think it's important that we all read these contracts very thoroughly before putting our money into them. So here we go. This illustration assumes that the illustrated non-guaranteed elements will continue unchanged in all years. However, this is not likely to occur. Future premium charges and monthly deductions can vary at the company's discretion. Actual policy values and benefits may be more or less favorable than the non-guaranteed values and benefits shown. So you'll see it may be more or less favorable, right? What I can say is that they've been nothing but less favorable. And if you look at the history of life insurance companies with universal life platforms, and this is just the third iteration, they had traditional universal life that started back in the early 80s, then variable universal life, and now indexed universal life that has been progressively getting worse and worse and worse on their insurance charges going up, their cap rates coming down. These things happen, and once again, these are the things that you are not in control of, and control is one of the most important components of anything we put our money into. This is a big function that, to me, is something that it may be more or less favorable. So they're saying it could be better, but history shows that it's going to be worse. And I'm a big believer history has a habit of repeating itself. I can't sit here and guarantee that it's going to be worse, but I can guarantee that you're not in control of those results, right? That's a big thing. So policy changes, premium changes, and disbursements shown in this illustration will not occur automatically. So as I go through, I'm going to show you the numbers, and I'm going to show you income. I'm going to show you, borrowing against it for the RELOC feature. Just know that these things aren't going to happen automatically. They're not automatically in place, and we'll talk about that as we go here. So the changes must be requested by contacting United of Omaha Life Insurance Company, and that just is what it is. So go down through here. Some of this stuff is really basic. Because I'm not gonna read all of it, but what I will do, because I've zoomed in enough here, if you are somebody who wants to read every line of this contract, I'm gonna just move fairly slow as I go down through here, and you can read each section. Just pause this video, read the section. I really encourage you to read every word in this contract if you're thinking about buying. That's just to me is kind of a no-brainer if you're looking to do that. So life insurance company, life insurance coverage. This is an interesting one. Income Advantage IUL is first and foremost life insurance protection. Your income helps provide for those who count on you. Income Advantage IUL can help provide protection from the financial consequences of your death by replacing lost income, paying for college expenses, or covering any expenses that come due. So think about this. It's being sold as this Income Advantage, and just the word play on Income Advantage IUL makes you think this thing is designed to help you build income later in life. But right here it says, no, this is designed to replace your income with life insurance should something tragic happen to you. That is the purpose of this. So this is another reason I don't like the nuanced, manipulative kind of plays in the wording with these contracts, because even the companies are kind of playing part in this. And like Mutual of Omaha says, well, we know that the Income Advantage IUL, that's going to be a sexy term, and they're kind of setting their agents up to go out and fail to an extent, because they're going to market them as like these things are income advantage products, right? Like, but it's not. It says right here, it's designed to replace income should you pass away, right? To make sure that your family college expenses or any other expenses that come due are covered, right? Your income is important to your family. Without it, your legacy could become one of their financial worries, right? Like that's, so goes on here. I'm going to pause here for a second and just say this. One of the things that I talk about a lot in the IUL challenge that I'm running right now is that when IULs are sold on upside potential and downside protection, that's a good story for IUL, and it's true. IULs have upside potential and downside protection to an extent. However, what that upside potential is important to understand what the life insurance carriers are saying, because what's being sold is that you have upside potential because you're participating in the market. So you can have upside and participation in that market but downside potential is protected because you got a floor on what the policy can lose, right? Like you can't lose quote unquote money, even though if the market does zero or negative, you're still going to have insurance charges, fees, admin costs, all these things that come out of the policy. And so you can have kind of a negative year in that context. However, these are being sold as the upside potential is due to the market participation, and you got all this upside growth potential. But here's the bottom line. What the foundational component of Index Universal Life is it was never really designed to really focus on getting crazy upside potential, because if you understand how options work and how the life insurance companies and the life insurance industry leverage options, they're not leveraging options to get massive returns. And when you understand like the pure use of options is really just to use options as a hedge. Now, there are certain people out there that go out and they speculate with options and they can get massive windfalls of cash and they trade options and they do all these different things. And don't get me wrong, there are ways that you can go out and make just a load of money doing options and playing the options game. However, that is a highly risky, highly speculative activity. That is not what life insurance companies do. They do not risk, they do not speculate. They only do what is going to create a predictable result for them. And so when we look at this, we have to look at the options and the way they're participating in the options market strictly as that hedge. And so they're never really going to capture the high upside. They're never going to put you in a position where they're designing that high upside, because if they were able to do that and get you those good returns, I say this all the time, it goes back to, if the insurance company could get you the 6.25% on a predictable, safe basis that this illustration is being illustrated at, they would do it for themselves, because they could go out and do that. They're only getting 4% in their general fund right now. So if they could increase that by over 50% in any kind of safe, predictable way, they'd go do it. They just would. They'd take the earnings on the general fund right now and they'd at least take a portion of that and they'd buy options for themselves to create this result, but they're not doing it because it doesn't work the way that it's being sold to you. It just takes to use a little bit of common sense to understand this. Now, this is when we talk about what is that upside potential, I always say it's always just upside potential compared to the traditional universal life chassis. That is it. Now, in this, I love this because it actually states it specifically. I've never seen this before on any other illustration. It states it specifically here. Income Advantage IUL also provides the opportunity to accumulate cash value for future needs. You can select interest crediting options that are based on the performance of the S&P 500 market index. And even though your interest rate is based on the index performance, your money is never actually invested in the market, i.e. we're participating in it by buying call options, right? Utilizing some of your money. We're going to generate a profit in the general fund with your deposits and your premium payments on your cash value. We're going to take a portion of that money. We're going to create an options budget with it. We're going to go buy call options, and that's going to be the participation, because they're going to buy call options in the S&P 500. If the call option comes in and you do well, you participate and you get the upside, you get the growth. And if it loses and it doesn't work, well, then you just lost that options budget, and that's where you're protected at zero. I've done videos on this that break it down much, much more deeply than that, but that is the crux of it, right? So because of the interest crediting feature, this policy offers greater potential for growth than traditional fixed interest universal life, than a traditional fixed interest universal life policy. So that's the upside potential. It's not the upside potential in the markets. They're not trying to say this is some big sexy product. They're simply saying this offers upside potential compared to a traditional universal life policy. And when you understand how these really work, you understand that this is never going to perform at the 6.25% component that it's being sold at. And that has been my biggest challenge with this all the time. Not that this is a bad product, because if you fund this the right way, if you make sure that you understand why you're buying this and it fits your real needs, it can be a fine solution. It can offer a little upside potential compared to a traditional universal life. And you know what? It'll put you in a position where, maybe you have some capital on the side, cash on the side that you can leverage down the road at some point in time. But bottom line is, it's never going to give off the returns that it's talking about. If it would, the insurance companies would be doing it for themselves. And on top of that, your income, whatever income is derived from this, is never going to perform the way the income is being sold to you because it requires these returns. And in fact, having the RELOC feature just increases the amount of loans that you have and increases the risk that you have inside of these policies very, very, very dramatically. So, so what we have here, I just have here Index Universal Life definitions. You have a participation rate. So I'm gonna spend a little second on this. Participation rate is the overall index return that will be used in the calculation of the index interest credit. So a participation rate means if you have a 10% cap rate, and that means you can earn, if the S&P goes up by 10%, you get the 10%. If it goes up by 20%, you still get that 10%. If it's 100% participation rate, you get that full 10%. If it's a 125% participation rate, that means you would get 25% higher. So if the market did 10%, then you would get 12.5% return. That's how, if you have a 75% participation rate, that means you get 7.5% instead of that 10%, right? And so that's the key thing to understand. It's the cap rate and participation rate. Now, the cap rate is the maximum rate that you could be credited. The floor is the bottom. It's where you're protected, and that's key to understand. Now, this is just the calculation on how they calculate what the returns are and what's going to be credited to your policy. And it's so simple. So say the S&P was 2,000 and it went up to 2,150. They're going to take what it is now, what it grew to, minus where it started, divided by and 100. This is the participation rate, and then you divide that by the amount where it started. That equals 7%. So in this situation, you get 100% of 7.5%, right? So like that is how that works. Now I'm going to go to this page. I don't got anything marked here, so I'm going to just let you pause it here if you want, and you can check that page out, read through it. I'm not going to spend any time there. All right, so here we go. Living benefits of universal life insurance. So accelerated death benefit riders. So for chronic illness, these are really good features, honestly. This is a good component of the policy. Having living benefits inside of life insurance is something that I'm really passionate about, something that I think people need to understand the value of, because I use my example of my father-in-law a lot, who got diagnosed with pancreatic cancer and we decided not to use traditional oncologists and traditional chemo and radiation and stuff, and we were able to utilize alternative treatments in large form because, listen, having access to living benefits can pay for the medical expenses that you have, and you get to control your own medical directive. So this component, whether it's chronic, whether it's terminal illness right here, these features are fantastic. Now, the loan side of it, it says you can access your policy's surrender value by taking a loan from your policy. So here's the deal. You're not, this is interesting. Like, the wording here drives me nuts. You're never taking a loan from your policy, right? It says here, you're leveraging your loan as a loan against your policy. You're collateralizing your loan, right? Which is, it's kind of interesting to me that the life insurance company would even write it like this. It seems completely non-compliant on its own, but this is a life insurance company's illustration. So when you borrow against your policy, when you take a loan, a lot of people say that you're borrowing from your policy, and that is kind of lazy lingo in the industry. But what you're really doing is you're borrowing against your policy. You're utilizing the cash value in your policy. You're borrowing against it. The life insurance company is giving you a guaranteed loan, collateralizing the cash that you have to guarantee that loan with them. And so, two separate transactions. It's important to understand that is the case. And I'm going to get into why that's the case, and it's so important to understand that here in just a bit. Now, when you request a loan, you can choose from two types of loans: standard loan and index loan. MPIs use the index loan feature. That is important to understand. I'm going to get into that as we go down here. Your policy also comes with a lapse guard rider. So that just prevents it. So your policy you'll never have a tax consequence if this policy lapses, right? Because if it lapses, you could get whacked with a pretty significant tax consequence, especially because of loans. The reason this is here, because by taking loans, you significantly increase the chance of your policy lapsing. What this does is it doesn't prevent your policy from lapsing. It doesn't prevent you from running out of money. It prevents you from getting whacked with a massive tax consequence in the case that it does happen. And believe me, there is a reason they put this on here. The reason is to avoid massive class action lawsuits, or at least to mitigate the risk of massive class action lawsuits in the face of policies lapsing. So let's get into the ledger. This is fun. So you can see here, once again, we got the death benefit increasing, death benefit option option B increasing years 1 through 26. Option B, which is level death benefit, years 27 through 80 in the policy. We got 100% of our money is going into the S&P index. We're assuming a rate at 6.25%. Now, if you've watched any of my other content and you've seen the IUL challenge that I've done, you know that this is never going to perform this way. It's never going to reach these numbers, even in the greatest bull market that we've had. The assumed illustration rates have never been hit by these IUL companies over a 10-year period. If you don't believe me, I would say, and you're watching this and you're a consumer, check out my IUL challenge video. I put it up here in the corner. This challenge is really just calling IUL agents out and saying, hey, listen, if these policies are going to do what you say they're going to do, we just went through with this upside potential story. Well, we just went through the greatest bull run in the history of the stock market, right? And if these truly participate in the upside of the indexes, right, of the stock market, they should have just crushed it over the past decade. They should have just annihilated any expectations that were illustrated, because, I mean, if they couldn't do well then, when are they ever going to do well? They're not going to do well in a bad market or a more flat or up and down market, right? And so I started this IUL challenge, and the reason I started it is because these policies never perform the way that they're illustrated. And my call to action is, show me an illustration that's 10 years old, out of the surrender period, that the original illustration is actually worse, where the new in-force illustration, the current status, the in-force illustration is outperforming the original illustration. If you could show me that, I'll give you $500 and I'll bring you on my channel and tell everybody what a rock star you are. Because if you can do that for your clients, you deserve some credit. You deserve to be paraded as an amazing agent, because there are ways that you can do it, but they don't do it with MPI. And that's something that's really important to understand. Now, getting to this, I want to talk about a couple things. Let's go through these numbers. This 6.25%, listen, they don't let you manipulate that number. And I get the reason the regulators don't let you manipulate it, because they don't want you to make the number bigger. I don't think that number should be any bigger than 5%. Once again, this isn't that I think this product is bad. It's just missold. It's not going to be this great income vehicle that you're being sold it as, right? It's just not going to work that way. So what we're looking at here is getting into this is you're looking at 18,000 premium, right? I always say this is not for real estate investors, okay? If you want to do infinite banking, if you're somebody like they always say, when I watch MPI, they always say you can do MPI with infinite banking. This is better for infinite banking than traditional whole life policies, or than a high early cash value whole life policy. And I'm going to sit here and tell you that it's not. And here's the reason why. Because year one, you only have 38% liquidity of your money. Year two, you only have 71% liquidity of your money. So if you're a real estate investor, if you're looking at infinite banking, a big component of the strategy and the reason you're doing infinite banking is to have liquidity, use, and control of your money. And when you put your money into these policies, if you want to turn around and access it for real estate or for anything of that nature for your business, you're losing a lot of the access to your capital now, because you could see 18,000 going in, I've got $17,000 of accumulated value. So that seems really good, because this is a maximum optimized policy, right? So that seems like it'd be really good. But the bottom line is the surrender value, because of the surrender charges, you only have liquidity of nearly 7,000. So that's a big problem. Like if I needed that money for real estate, for investments, you could buy other smaller cash flow investments, maybe a car for Turo or a trailer to rent on Outdoorsy. I've done both of those things as well. And they're all great ways to create side caches of income, which is the purpose of utilizing infinite banking, is the foundation of your financial life to have all your money run through. But in this scenario, you with IULs, you don't have the liquidity that you need. And you can see by year 5, the accumulated value is $95,000, but you still only have access to $57,000. Now, 2046, you put in 72 and you still only have access to $57,000. And so this is a problem. You cannot use MPI. I don't care what they say, how sexy they try to make it sound. These are just the numbers, guys. Like, these are the numbers. You cannot do infinite banking because of the lack of liquidity and because of the surrender period. Look at year 10. You've put in 223. You have liquidity of 127. Now, here's the deal. I'm going to back up now. I'm going to back up because I did add the RELOC feature into here. And so this isn't telling the full story. Okay. So I just want to be fully transparent. The RELOC feature is saying when you borrow, when you save, we're putting in $18,000 a year. And what happens is we're accumulating. We have cash value here. I'm going to borrow against it. I'm going to take a loan, and it's going to create a loan expense. You see there's an annualized distribution total, and then there's a loan balance, right? And so what I'm doing is I'm utilizing this loan, and I'm buying effectively more insurance. So the idea here, the whole foundational component of the RELOC feature is the fact that you can build in, and I'm going to get to it down below as I go down through this, the disclaimers later in the policy, but they build in 50 basis points of positive arbitrage in this illustration. Now, that's due to regulation AG 49A inside of the IUL policies. This is able to be illustrated this way. However, because of, I guess I'll call it a scheme, like an MPI, and the fact that they're seeing people illustrate these, and they didn't intend on it being leveraged so much. And there's been a lot of class action lawsuits. There's been a lot of challenges because these things, once again, don't perform the way that they're being shown, and that positive arbitrage actually doesn't really occur. In fact, when you get later in life, because of the loan exposure and because of the loan expenses, you're about to see that there's a lot more risk in these things than people want to acknowledge. And so what happens here is you take this $10,000 loan, and they repeat this on a regular basis as time goes on. Now, here's the deal. Every time you go to do this, you borrow against this policy. What he does is you're with MPI, you're basically getting a loan balance. Now, you're taking this money and you're buying more insurance with it. That's really what you're doing. You're starting another MPI plan that would look exactly like this effectively, and you just start stacking these policies on top of each other. Now, what I'm doing for the purposes of this is, if we were to have positive arbitrage, and if it worked where you had 50 basis points of guaranteed positive arbitrage or more, that could happen speculatively, then listen, this would be amazing. But I'm going to tell you, if it worked like that, I would be the first one to go out and do this for myself, because it would be a phenomenal construct and financial strategy. But the bottom line is it doesn't work that way. And it's not going to work that way. And in fact, your risk is going to be significant if you decide to do this. Now, as we go through this, Curtis Ray is always saying, always be compounding, the power of compound interest, right? But the bottom line is compounding can work against you too. When you look at these loan disbursements, you can see you got $10,000 of loans going out this year to pay for more MPI plans effectively. But that loan, that $10,000 loan, guess what? Look at this. It was 166 is your loan balance, and then you took another $10,000 of loan, but because there is an expense for those loans, now you have 182,000. So the loan balance is getting higher and higher and higher. These extra fees work against you, right? And you need to understand that. So when you look at this, you can see here that the loan balances in this one policy, and just remember, this is happening over and over and over again. But if you can qualify for the insurance, right? That's the other thing. The MPI plan, for it to work, it assumes you're going to remain healthy forever, which I don't know about you, but I'm not going to bank, and I'm pretty intentional about my health. I'm pretty healthy myself. I'm not going to bank my whole financial success on my ability to stay healthy. What happens if I get into a car accident and I get disabled and now I don't qualify for insurance the same way? What happens if I have a stroke or I have something that happens, unexpectedly? I get diagnosed with cancer unexpectedly. This is the world we live in. I'm not putting my financial success and my family's financial stability and success at the whims of my ability to get more insurance year in, year out, right? Like that just makes no sense. It's just an unnecessary risk. And so when you look at this by year 20 at age 60, and this is the example I have right here, by the way, that I had somebody build. But what I will say is the actual illustration that I got was much more aggressive than this. In fact, the loan balance at this point in time was actually higher than the surrender value because they're trying to build in this baked in arbitrage to make it look optimized. I didn't have it in me to do that because it's even too risky at this level to make it so the loan balance, and I could have taken $18,000 loans, the amount of the premium, and it would have worked and it would have looked really good, but the loan balance would have been huge and it would have been even more dangerous than what I'm showing you. And so I'm just trying to even come at this from this perspective, but the loan balance at 256 and the surrender value at 346. So what happens in this situation is, what happens if we have a flat year? Well, now you have an extra 4% expense on this loan balance that you're going to have to pay. That's a real expense, and that's going to come out of, it's going to be paid for by the surrender value of the policy. So that's going to have a negative consequence. So now not only do you have the expense of the insurance in the policy, your net amount at risk. Remember, they always say the net amount at risk in the policy is what the insurance is based on. Well, guess what? Because of the fact that you did increasing death benefits while you're funding the policy, look at this. You got 375-ish thousand of life insurance right here. And what do we have here? We have just about $360,000 of life insurance, right? So it didn't really go down. The net amount at risk hasn't gone down, but what has happened is if you've gotten older, and so your insurance cost goes up and up and up and up because this number of life insurance hasn't shrunk, and that amount of life insurance that you have is going to continually put stress on your surrender value of your policy. And when you add in the fact that you have stress of the loans now in down markets, that makes it harder for the policy to perform, because now with a 6.25% assumed rate and with cap rates dropping consistently, it makes it so even in a good year, it's not going to be able to make up for it. And this is where these things spiral out of control. And you have to understand this stuff. So now we can go down here and just kind of look at age 66. I did not pull income out of this, and I'm going to explain why. And so let's look at this. And we look at the loan balance is 380. The surrender value at that point in time when the last year we fund it is 563. So once again, this stress on this is pretty brutal. The real illustrations I had, once again, the loan balance was higher than the actual surrender value, which is crazy town. I mean, it's crazy town. Like the fact, if you don't understand the type of stress and risk that puts you in, then you shouldn't be doing these policies. You never want to put your money into anything that you don't understand. And if that doesn't make sense to you, you shouldn't be doing these policies. Now, here's the bottom line. When I go down here, I didn't do income. And the reason I didn't do income is because of the fact that I didn't want to make it into something that it wasn't in just this one illustration, because the bottom line is we're looking at these premium payments, these loans. Remember, you'd be stacking all of these loans, and you'd have a lot of policies if you did MPI. And so what it is, just being able to show income on one loan or on one policy wouldn't really give you any clarity on anything. And the other component to this is this only matters if you get to this with this amount of income. What I will say is that this is the illustrated value that you have 563,000 based on this 6.25%. You're not going to get to retirement with 563,000. If you get there with 500 or with 250,000 I'll be impressed. Once again, this isn't a matter of it being good or bad, but look at this. I mean, 5, 6, 7, 8, you're still looking at $300-something thousand of life insurance here. The net amount at risk is the surrender value minus the death benefit, right? So like that is the net amount at risk in this policy, guys. That is dangerous. The accumulation value in these policies actually hurt your ability with the insurance. They hurt the expenses of the insurance, and that works against you. So you go through this, and once again, these numbers don't really matter because they're astronomical and they're never going to come into play. You can look at them if you want. Here, I'll just slow down for you for a second. It is what it is. I'm going to pause here. I'm not going to spend a lot of time on this page either. But it just explains how the interest crediting methods, what your options are in the policy, so on and so forth. Pause that and go back and watch it if you want. This just goes to show, I'm spending a little time just showing you on this. I highlighted this green because this is the cap the index that we chose to participate in. This is the one that MPI does, 100% participation rate, 10% cap rate. It's a 12-month point-to-point, and that is what they do. And so they guarantee that you have a 3% cap rate, meaning the cap rate can't go below 3%. So actually, I want to spend a little time talking about that. So with the 3% cap rate, right now the cap rate's at 10%. What that is saying is that on a guaranteed basis, they cannot lower your cap rate below 3%. So what that is saying is they can reduce your cap rate from 10% all the way to 3%. And the cap rate is the most you can earn in the policy. Right now, it's illustrating at 6.25%. That means they can reduce the cap rate, which is the max you can earn, to less than the illustrated value in the policy. If that isn't a cause for concern, I don't know what is. So just take that into consideration. Okay, so let's look at this. Hypothetical performance. This is something that's really important to understand. So all of this is minus the cost of insurance and fees. This is just the actual crediting rates that you're going to get inside of the policy. The minimum historical average is 3.93%. That's the minimum performance. And then you back out the cost of insurance and fees, your policy is going to perform far less than that. But this is showing there have been 25-year periods of history where the minimum, based on their math, where it could happen. This is a mathematical possibility that your money goes in there. And I promise you, if you buy an MPI plan and this happens, you are doomed. You're going to lose everything that you put into this thing and more. Probably like not more, because you can't lose more than you put into it. But it's just going to implode. You're not going to have anything there. Now, the average is 6.25%. This is what their algorithm does. This is what AG 49A regulation said. This is why you have to show the illustrated rates based on everything. But remember, this 6.25% is minus, you have to back out the cost of insurance and fees. And I'm telling you, they don't perform like that. Here's the deal. If we look at during the greatest bull run ever, this is showing the history, the past 20 years inside of the S&P 500, where it's going. When we look at the greatest bull market ever, even in those times, we have some flat and negative years, right? We got 1, 2, 3, 4, 5, 6, 7 years out of the 20 during the greatest bull market run ever that we had negative years. So that means there's only 13 positive years. And if this happens, like, it's not a matter of what happens while you're in the accumulation phase of the MPI plan. It's a matter of what happens when you're in distribution phase. But the challenge is, because of the fact of the RELOC feature, you're always in distribution phase because you always have loans against the policy. And these negative years, those loans have bigger expenses that go with it. And this is really, really important to understand this feature. It is the RELOC feature that puts you at more risk because of this. You are not going to avoid negative years. You are not going to afford downsides. And then when you get to make it worse, if you have all those loans out and then you compound the loans by taking income in retirement, these things are just going to be a train wreck. I don't know how else to put it. So no lapse protection. I got all this highlighted, so it's important. So no lapse protection. A minimum no lapse protection period is available as described below. No lapse protection is not a guarantee that the policy can never lapse. Sounds counterproductive. See your policy for additional information regarding no lapse protection. Death benefit option and specified amount changes, withdrawals, and loans will affect the no lapse protection. If any of these actions are taken, the policy no lapse protection could be lost and additional premiums may be required to keep the policy from lapsing. Okay, what is that saying? That is saying if you take loans, i.e. RELOC, you are potentially negating your ability to take advantage of the no lapse protection benefit in this policy, right? You are waiving your right to the no lapse protection by taking loans. This is saying you will lose, and it's basically saying we're going to have to charge you more to keep this policy in force if and when that happens, right? Like that's important. No lapse protection premium. As long as you continue to pay premiums as shown in the premium outlay column of this illustration, the policy's death benefit is guaranteed through policy year 23. Oh boy, that's not very long. This assumes your premiums are paid when due. The yearly premium required to guarantee the $363,000 of death benefit to policy maturity based on the guaranteed minimum interest rate and the guaranteed maximum cost of insurance charges would allow this policy to qualify as a life insurance policy under the applicable provisions of the Internal Revenue Code. So this is basically saying you got to pay your premiums. If you take loans, you lose the no lapse provision. They're setting you up to make sure that you have, they're basically stating that this is a life insurance policy. You're not buying this for any other reason. If you utilize it for loans or anything that of that nature, they're shifting the risk completely to you. And if those policy loans implode, they're washing their hands. They are not required to protect you from the policy and the death benefit from lapsing. And if you want to keep it in place, you're going to have to send them more money just to keep the life insurance in place. It has nothing to do with your ability to get income. That ship has sailed. You're not going to get the income from it. You're going to have to cut a check just to keep the insurance in place, which at that point in time, it's going to be super cost prohibitive to do that. However, the policy has the potential of developing a higher accumulation value if you pay a premium higher than the amount required to maintain the no lapse protection, right? So this is basically saying, yeah, if you pay more, you're going to get more. That just is common sense. And so it's a good thing. I mean, obviously, if you need the insurance component to that, it's a good thing. So the problem is most people aren't buying these for the insurance component, right? Like that's the bottom line. You wouldn't be doing it the MPI way if you were buying for insurance. That's the way I look at this. So specified amount changes. Changes in specified amounts are allowed once a year. Okay, so I'm going to just go to where I highlighted. If you want to pause and read the rest of it, for brevity's sake, go from there. A decrease in the specified amount during the first 14 years of the policy will result in a surrender charge. Oh yeah, so this is saying if you have to reduce your premium payment in the first 14 years, you are going to get hit with a surrender charge. This is another part where you just don't control the elements of this. With a whole life policy, you have the 7-pay test, and so whatever you commit to, you have to commit to the base for 7 years. But if you did a 40-60 policy design with a whole life policy, and let's call it $10,000 a year, that means 40% of that is base. You're committed to the $4,000 a year premium for 7 years. After that, you have the flexibility to utilize other features in the policy that you have no more expenses and there's no surrender charges, and it is what it is. In this, you have 14 years, and if you reduce the payment in this, you're going to get hit with a surrender charge. That is, it's just not good. That's just not good. Disbursement options. You have the opportunity to access your policy's surrender value. Okay, yep. If you do, you're going to void the no lapse guarantee provision. So just remember that. Disbursements can be taken as policy loans or withdrawals. Now, so the whole purpose here is we utilize policy loans. MPI utilizes policy loans. Don't want to take withdrawals because withdrawals come with surrender charges and so on and so forth. So And you wouldn't get the arbitrage. It wouldn't look as sexy if you used withdrawals, right? Even though it might be a potentially better thing in certain circumstances, depending on how much cash value you had and the order of distribution. That's another conversation. But policy loans are available up to the amount of surrender value, less any loan interest owed to the end of the policy year, and 1 month's monthly deduction amount. When you request a loan, you choose the type you prefer. So you choose the type of loan that you prefer, whether it's an index or a standard loan. Additional loans must be the same type as the existing. So once you start with an index loan, you have to continue on the index loan. You can't say, oh, I have this block of index loans. I want to shift that because the market and the economy is shifting. I want to shift that to a wash loan, which is a standard loan. So that is what it is. When you start down the indexing loan route, which would be year 3, when you do the first RELOC loan, you are now committed to utilizing index loans the entire time during the policy. So important to understand. What do I have here? So with index loans, for the purposes of this illustration, this is where I was talking about before. For the purposes of this illustration, interest credited on the index loan values is assumed to be no more than 50 basis points, 0.5%, above the index loan interest rate charge. So this is saying, and this is saying you're going to earn 50 basis points positive arbitrage on everything shown in this illustration, which is a load of malarkey. It's never going to work like that on an average basis long term. It just doesn't. I'm telling you. I've seen it. And if it worked that way, here's the deal. This is why I'm doing my IUL challenge. If it worked that way, I would have droves of agents coming to me saying, hey, Chris, I've got all these policies that outperformed the original illustration. And guess what? I've had 85,000 views of my content watching my IUL challenge stuff, and not one agent has stepped forward showing me that. So that is proof. I'm sick of all the IUL agents mis-selling what IUL is and stating that it can do all these things, yet, and they like to talk about it, but the bottom line is most of the people selling IULs haven't sold them long enough to even know what they're going to do. They look really sexy on paper, but when you get into the mix of it, they never perform the way that they're showing you, right? So they're never going to charge you more than 6%. The current interest rate being charged on an index loan is 4%. This illustration comes assuming that you're going to have 4%. So when you borrow against it, that amount that you have a loan against, you're going to get your credited earning 4.5%, right? That's the 50 basis points of arbitrage that's being shown here. Withdrawals, just don't do it. They don't do it inside of MPI. They're not going to use withdrawals. If you do it, subject to a $100 charge. There's other surrender charges if you do it too early. You're not going to do it. You're not going to do that inside of an MPI plan. I'm not going to read this, but if you want to pause and check that out, go for it. Same here. I'm just giving you a chance to look at this illustration for yourself. I'm going to pause this, go through it if you want. Listen, I know if you're here, I'm 47 minutes into this video. You spent a lot of time dedicated to learning this, but if you are going to spend your money somewhere, I believe you need to understand what you're doing with your money, and you need to understand what's going on with that. Now, guaranteed refund option comes with this policy. It's going to look different on every illustration, but 100% of the premium that you put into the policy is available back to you in year 20, 21, 22, 23, 24, and 25. Now, that sounds really good, but the bottom line is they're willing to do that because let's say you put in $200,000 of premium in year 20, $10,000 a year. They're saying that you could take advantage of this guaranteed refund option and just cancel the policy and get your $20,000 back. That would be the crux of what they're saying. But the problem is 20 years from now, that money is going to have half the purchasing power. So you basically gave them a loan for nothing, and they're going to give you that $200,000 back, but it's only going to be worth about $100,000, if not less, in today's purchasing power money. So inflation will have killed the leverage that you have on that. And so just make sure you take that into consideration. Cost of insurance rates. This is the monthly rate for each $1,000 of insurance. The non-guaranteed monthly cost of insurance rates are subject to change by Mutual of Omaha, life insurance company, but shall not exceed the guaranteed maximum monthly cost of insurance rates shown in the policy. So they are showing current rates, right? But they're saying this goes to show you your cost of insurance can be increased. Cap rates can be reduced, as I said earlier. Cost of insurance can go up. And then when you tap into the fact that the options costs and budgets that are outside of their control completely get thrown into the mix, this thing, you start to see where these things break down. And there's so many cracks in the armor for this. It doesn't take everything going bad. It takes one of them to go bad. And it doesn't work for you, right? That just is what it is. Increasing the death benefit is equal to the specified face amount plus a policy's accumulated value, right? So increase this amount increases during the accumulation means no. So I said this earlier. This is what I was talking about, where as your cash value goes up, your death benefit is going to increase during your production years, during the time that you're funding the policy. That's going to mean there's not a decrease in the net amount at risk for insurance, which is one of the things that like Doug Andrew and Curtis Ray, they tout that, well, it's the net amount at risk that's really where the insurance charges come from, and those should go down. Well, based on how they structure them, they speak out of both sides of their mouth. They go, oh yeah, that's a benefit. Yeah, it's a benefit, but you don't structure them to take advantage of that benefit. And so when that happens, when you have flat years, because you're getting older, the net amount at risk doesn't go down. So the cost of insurance is there. They can increase those costs of insurance. And because you get older in its annual renewable term, basically inside of the policy, you're paying at that age every single year. So your cost of insurance is going up there as well, right? And so then when you reach 55 and 60 years old and you have a flat year, that cost of insurance just decimates the performance of a policy, and not to mention the loans compound against you. So it's a double whammy as far as that goes. So the guaranteed interest rate, this is the interest rate that the company guarantees to credit the accumulation value, which is 2% on the fixed account and 0% for the indexed account, right? So when you take an indexed loan, you can earn 0 in the policy, and then you have whatever the indexed rate expense for insurance, anywhere between 4% where it is now ultimately, and 6% is the highest it could go. And so, and by the way, if the fixed market keeps going the way that it's going, I wouldn't be surprised to see 6% index rates in the near future. So just keep that in mind. Non-guaranteed indexed interest crediting strategy illustrated interest rate. Okay, that's a tongue twister. This interest rate is not guaranteed, and the actual interest credited amounts will be determined based on the underlying participation rate, cap rate, floor rate in place at the beginning of the index segment, as well as the actual performance of the index over the duration of that segment. Actual results may be more or less favorable than shown. So this is just saying all the things that is kind of summarizing in one place. You saw the participation rate is guaranteed, by the way, to be at 100%. With their strategy. The cap rate, it's at 10% right now. Could it go up? It could. Do I think it's going to go up? No way, no how. It's been dropping ever since they released this product. It's been going down and down and down. And they show that they have the contractual right to reduce your cap rate to as low as 3%. The floor rate in place at the beginning of the index segment as well. So the floor rate is 0, right? Like you can't lose money in the policy. It's going to be 0%. And so this is illustrated at the current assumption rates, and the performance will, if they keep lowering these expectations, lowering the cap rates, increasing the charges, whatnot, then the performance is going to be less than. And that's what this is saying. It's basically their clause saying, hey, none of this is guaranteed, and buyer beware. Actually, sorry, I didn't mean to go so fast. Let me allow you to look at that. It just gives the definition of surrender charges and the surrender value. You can pause that, read it. Illustrated value, it just goes through. This is all the lingo that you need to understand. And if you have any questions on this, go ahead and comment in the comment section below. I will do my best. I'm not going to go through all this. These are just disclaimers, but it's all really important. Once again, pause it when you want. I'm going to give you just seconds to pause it and go from there, because this is just really important stuff, guys. And then here is the signature for it. And so, okay, so now what we have is we have the same kind of deal. I'm going to go back through here. I showed all this above. This is showing on the non-guaranteed interest rate. It's an alternate scale. This is kind of going based on the assumed rate, like what happens if the policy winds up being in that lower echelon, right, of a situation. We're looking at the policy. You're going to end up with about half of the income that you're expecting, right? Like it just is what it is. The policy, you can see here, this is the non-guaranteed. This is showing the what will happen if the interest credited is less, right? This is what you saw above. That's the number. If it performs at a lesser rate, and notice they bury this all the way lower. They should have showed this they should just have this one sheet, not just have the sexy sales piece up at top. If it performs less than, you're going to have $258,000 of cash value, not the 563. Now, will it be this bad? No, it might. I don't even think it'll get this bad, to be quite frank. But what I do think you'll probably have between $300,000 to $350,000 is really where you'd end up with in cash value at that point in time, which is a far cry from the 563. And when you look at the loans and the exposure and everything that goes up earlier in the policy that is shown, you look at this and it's just like numbers don't lie. You just don't let the sales tactics get you into this, because you have to understand. You have to truly understand where your money's going. And I'm just kind of coming through here. Tamara 7Pay. So this is basically saying you can put up to $24,000 a year into this policy in the first 7 years. That would get this thing max, like just jammed out and efficient. But even if you do that, you're still playing with fire. That just is what it is. So I go through this. This is just going through more loans. You can see this is the loan report, the loan balance. These loans, I mean, they're big. You're talking about $563,000 in cash. I'm, once again, more conservative. You got $366,000 of loans at that point in time. It's just, it's just dangerous. I feel like I'm beating a dead horse at this point in time, but I'm going through here because I want you to see every page of the illustration, and it's a bit repetitive, and that's the nature of these things. But you need to know, that these deeper components of the illustration exist. And I did not illustrate retirement income because I just don't think there'd be anything there. Once again, no retirement income. Index loan charge interest. Index loans charge interest at a rate that we declare, but never greater than the index loan guaranteed maximum interest rate of 6%. So that's what I'm saying. Interest rate being currently charged is 4%. It can go up to 6%, which is what I kind of said before. This is just rehashing. Notice they put this in multiple places, showing that it's illustrating 50 basis points for the 50 basis points of positive arbitrage for the illustration purposes only, right? It's AG 49, once again, is coming out. 49B, AG 49B is coming out, and it should be fixing that and not allowing them to illustrate positive arbitrage, which is going to actually, hopefully, do some good things and put an end to all these illicit sales tactics. Based on this 6.25%, you can see the net internal rate of return cash on this based on the surrender value. That's the surrender value, the net cash value. Negative 61%. You're losing a lot of liquidity of your money when you do this. Once again, this is after all the charges and the fees, right? That you see, and this is assuming that the policy performs with this average index crediting rate, and that costs don't go up, fees don't go up, insurance charges don't go up, and the cap rates stay high, right? Like that's assuming all of those things. I don't know about you, but I don't trust that at all. And when you look at this, you're looking at 20 years from now, you're looking at a 5.4% rate. And that's, once again, I don't think that's got a shot in God at that happening, honestly. If it did, once again, I wrote the IUL challenge here. If that were able to happen, I would have my mailbox flooded with illustrations showing me these policies outperforming the illustrated rates. It doesn't happen. I'm telling you, it doesn't happen. And so when I look at this is why when people go, Chris, why do you sell this outdated, archaic product like whole life insurance? Is because with a whole life policy at 20, 25 years, I can show an internal rate of return between 4.5% and 5%, but I can show that on a pretty much guaranteed basis. And I can even make a really strong argument that if anything, it's going to outperform that right now with the interest rate environment that we're in right now. So I always look at my decisions. What's the upside? What's the downside? Can I live with the downside? And in this context, I'm looking at this from the perspective of if I have a potential 50 basis points of upside, but with that upside comes a ton of risk and I can lose my money, I'm never going to do that. And anybody that does that, in my opinion, is foolish, and you get what you deserve. So this is just more internal rate of return stuff on this. And listen, whether this isn't it. What I would say is obviously if you get an illustration from MPI, just lay it side by side next to this video, go through it, read it for yourself. Don't let them guide you through it because they're going to skim over the things and not focus on the components that are really important. And this is the end of it. This is just kind of like summary stuff. None of it is super important as far as that goes. But if you're still here, I want to applaud you for either trying to learn your craft and learn the illustration components of why these are so dangerous, or you're somebody who's looking to implement this in your own life for yourself. You're an hour into this now, so it shows that you're dedicated to learning about this for yourself. So if you have any questions, comment in the comment section below. If you need help with anything, reach out. I'm happy to have one of my team members work with you. We have what's called the Life 180 Clarity Call. We can help guide you and just answer any questions that you have. I know I get a lot of questions from people asking, well, if I can't put my money here, what do I love? Because I love the story of MPI. I love the, how it's being sold and what the book. The hard part is, I'm not going to lie to you. I read Curtis Ray's book, the Compound Interest book, and I tell you what, the first 70 pages had me. I'm 100% in alignment basically with most everything he says. It's where we get to the execution phase where he loses me. And the reason he loses me because he's putting people into this product that is really dangerous. That's not going to perform the way that he says. And that's where I lose people like Doug Andrew. That's where I lose people like Curtis Ray. And this, I'm telling you, it's going to be a real challenge. These policies are going to have a lot of problems in the next 10 years is my guess. And when that happens, I think there's going to be a lot of challenges. And what looks good right now is not necessarily really good. And just because it looks sexy on paper, read the fine print and understand what you're getting involved with. So if you haven't already, subscribe to the channel, hit the bell. That way you get notified every time I launch a new video. Once again, let me know if you need anything. Click on the link in the description below to set up a call with one of our people. And have a blessed, inspirational day. We'll talk to you on the next video. Take care.